Well, very good morning to everybody. Welcome to this, our next in our series of financial updates delivered directly to you in your home or in your office. I'm delighted to say that our office is now open again, albeit under slightly different circumstances where we're working with split teams. We're working with social distancing and obviously sanitizing a lot. But we are welcoming clients back in when it's absolutely necessary. We do hope obviously to be back as soon as possible with full teams and also welcoming clients back in for face-to-face meetings. So welcome again to our next in our program. We have had amazing feedback from our previous webinars and I'm delighted to say that I'm sure you'll be agreeing with that for the next one. I'm delighted that we're joined today by Chris Ralph, who is St James's Place Chief Global Strategist. We've known Chris for many years. Some of you may have already heard Chris speak at previous events, and I'm delighted that Chris is going to be talking to us today about his views on where markets are and hopefully give us some hope for the future. So it gives me absolute great pleasure to hand across to Chris this morning. Good morning, Chris.
Good morning, James, and good morning, everybody. I'm delighted to be with you. Thank you, James, for that kind introduction. As he said, I think I've met many of Morpeth's clients in the past at previous events. And whilst I'm in a role as Chief Global Strategist from the beginning of this year, many of you may have met me whilst I was in the guise of Chief Investment Officer, a role that I held for 10 years whilst I was at from the start of my career at St James's Place. I've been in markets for over 35 years now, from investment banking through fund management into wealth management with St James's Place. So what I'm hoping to be able to do is share some slides with you now. So James, do tell me if I fail the technology test, because I might be CIO or might have been CIO and Chief Global Strategist, but I'm definitely not a technologist. So I'm just going to try and share this now. Is that viewing?
No, not as yet, Chris.
Okay, let's see if that works. Share. How's that?
Nothing at all.
That's working, is it?
No, still haven't got anything on the front bit.
Why is that not working? PowerPoint. There you go.
Oh, there we go.
Okay. Third time lucky, as I say.
Right, here we go.
Right. So what I wanted to do was speak for about 30 minutes, and then I think we've got some questions after that. And as James kindly said, what I want to do is sort of give a view on what's been going on in economics and markets, but clearly with a COVID-19 overlay to that, because that's been the most substantial impact on markets that we've had, not just this year, but for many, many years. We've obviously been in one of the longest periods of economic expansion. It went on for 128 months on a global basis, and that's come to a very grinding halt this year. So my first slide, if I can get this to work, let's see if I can get this to work. Let's try that again. My first slide, go, is a review of the second quarter of markets, because markets actually bottomed on the 23rd of March. So that was when there was the peak concerns, not only about the impact of COVID-19, the length of time that it was going to take for a vaccine to be spread around the world, but also we hadn't seen the full extent of the support that both central banks and governments were providing around the world. But since that low point of 23rd of March, we've actually seen a very substantial recovery in markets. Obviously, this data goes to the end of June, and there's been some further movement on since there. But you can see that all major markets showed positive territory over that period of time, but most particularly in the United States, and in that the technology index of the NASDAQ 100. That rose by more than 30% over the second quarter and is now in substantial positive territory year to date. And we'll come on to talk a bit more about the components of that index and why that is why that shouldn't necessarily be seen as a bellwether for what's likely to be happening in markets around the world. Sadly, the good old UK has been the laggard of the major markets around the world. It only rose by a little under 10% and is still quite substantially down year to date. And again, that's something we'll deal with a bit later on. But part of that is to do with the makeup of the index and the focus on oil companies, energy companies, and on financial services companies, neither of which have done particularly well. I want to talk a bit about China as well, because obviously China went into COVID-19 earlier. That's where the virus purportedly started, and it came out of it more quickly. And I think we've seen some encouraging signs in terms of the Chinese recovery and therefore the impact that has had on perception in that country. So moving forward from there, what I wanted to do was look at that in much longer terms. So the line chart on the left hand side, I think, is the one to focus on here. And there's three lines here: in red, the US index, the S&P 500 index; in blue, the FTSE all share, so 700-800 UK leading companies; and in sort of grey, an index representing the Chinese stock market. And you can see how much the US market has outperformed over this 10-year period, since basically not far after the end of the global financial crisis. And that has been driven by what have become known as the technology behemoth stocks. So over that period of time, over the last 6 years, the big technology mega caps have increased their market capitalization by 5 times. So the market has become very, very polarized between the performance of those shares and actually the rest of the market. And if you looked at the US market ex technology, and even more pertinently, the world ex US technology, there's been not really very substantial growth over that period. So if one's been in technology, it's been great. Otherwise, it's been hard to be making a lot of positive territory. The other point that I think is worth recognizing is that, as you can see from the right-hand side of the grey line, there has been a recent bounce in the Chinese stock market. And there are some big technology companies there, like Tencent and Alibaba, who are big competitors on a global basis with the Amazons and Googles of this world. But actually, if you look at it in terms of the valuation of those companies, Tencent and Alibaba, they're looking substantially cheaper compared to their US counterparts. And that's why I think we have seen some quick recovery in the Chinese stock market over a shorter term period of time. So moving on to look at that Chinese recovery, one of the areas that data nerds like me spend quite a lot of time looking at is mobility data. So looking at the way in which consumers and workers have got back to normalcy in terms of their behavior. And what we've seen in China is not just in terms of traffic movement, which has got back to pretty much pre-pandemic levels, if not over that, across the major 100 cities in China, but in terms of the usage of underground systems across 9 major cities. Now, if you compared the black line on the left-hand side here to a UK alternative, in London, and many of you may have read about this, the use of the underground in London is still only at about 15 or 20% of normal capacity. If I were to travel into the West End today, it wouldn't at all surprise me I could get on to an underground carriage where I'd be the only traveller on that carriage. Very, very unusual and pretty disastrous in terms of the economics of transport for London. So the fact that we've seen this substantial bounce in Chinese economic activity, and added to the fact that actually the Chinese stock market, as can be seen from the graph on the right-hand side, hasn't actually performed particularly strongly despite these big very important technology names, and the development of the Chinese economy has given the opportunity for that market to push ahead, and that's what we've seen in the past few days. It's clearly been helped by the fact that an important Chinese newspaper that is heavily influenced by the government out there talked about the fact that it's a healthy stock bull market supports economic recovery, which is a good enough sign for saying that individuals should be buying shares themselves. The other thing that I think is important to note is that if you compare China's recovery from the pandemic compared to the recovery from the global financial crisis, if you wind back their economy 10 years or more, the economy was much more dependent in China on exports, and it was also dependent on relatively low value exports, and those exports have dramatically increased in value over the ensuing 10 years, much more focused on technology, for example, rather than on, I don't know, rubbish consumer goods. So let's compare that with the UK, and here I'm afraid the picture is not so exciting. You know, as I said, I'm a bit of a data nerd, and I absolutely love the chart on the left-hand side because this comes from a wonderful database which is called the Millennium of Economic Data that is held by the Bank of England. And so here we can compare what we're expecting to see in terms of economic slowdown in 2020 with the past 300 years of GDP data on the UK. Happy days for me as a data nerd. But what it is showing is not a particularly pleasant picture. The fact that the UK is having its sharpest slowdown since records began 300 years ago for gross domestic product. Having said that, if you look at the chart on the right-hand side, and one of the indices that we look at quite a lot because it's quite forward-looking is what are referred to as purchasing managers indices. Now they give up-to-date idea of economic performance, and the key level here is 50 because if one's recording an index on a purchasing managers index of over 50, that's showing expansion, and below 50 is showing contraction. And obviously there was a collapse in the index in April and May, but we're already seeing a sharp rebound in economic activity in the service sector, and in the manufacturing sector we've gone back into expansionary territory. But having said that, as we've seen of late, the GDP numbers are not particularly good, and that's been reflected in the number of job losses which have been announced across the economy, but particularly in the retail and travel sector. So whether it's shops and cafes or other retail stores shutting down or making staff redundant, or airlines and airports having to make redundancies, and indeed aircraft manufacturers. Clearly all of this is very bad news, and whilst the jobs data at the minute is relatively calm, in fact there was a number out which exceeded expectations this morning, as the furlough scheme begins to unwind, that data is still going to be quite alarming, and we will most likely, by most commentators' views, see unemployment at levels that we haven't seen for some years. Having said that, as we went into the coronavirus crisis, we were at the highest employment levels that we've seen for a generation or more, and that's meant that we've started from a good place and hopefully can recover back to that good place relatively quickly. So looking forward, what should we be concerned about for the rest of the year? I think there's probably two areas. The first is looking at second waves of infection of COVID-19. And obviously we've been going through over the past few weeks rising cases in the southern and western parts of the United States. That probably wasn't a second wave because actually the first wave hadn't actually concluded in those states. And that should give us pause for concern that the reopenings will have to be slowed down, and indeed some states may have to go back into lockdown. But it's my judgment that both in the United States, Europe and the UK, the governments in those countries will be very reluctant to have a full national lockdown that we had through March and up into May or June, that the policy of trying to have localized lockdowns to deal with localize infections, new infections, will keep the economy running more effectively than trying to have another national lockdown. And certainly from the employees at organisations like the CBI, for example, they've said that it would be really disastrous for companies if they have to go through a second period, a second hole in their revenues if there is a very substantial economic lockdown. The other area that I think is going to be of increasing focus over the coming months will be the US election. Happens at the beginning of November. The last 4 years just seem to have taken rather a long time through the presidency of Mr. Trump. But what I think is fascinating is that we've seen a real change in data over the past 6 months. So if you want to clock back to the beginning of the year, it was pretty uncertain as to who the Democratic candidate was going to be. There was a plethora of candidates, and Mr. Biden was in trouble in terms of the relationship that he had with through his son with a Ukrainian company, and the strong economic performance of the US economy was putting Mr. Trump in a relatively strong position in terms of re-election. But there's been a really extraordinary change. Not just has popularity ratings for the president substantially declined over that period to make the probability of a switch to a Democratic president more likely. It also seems reasonable as we sit here today to expect that the US Senate and the US House could become Democratic or move to the Democratic Party. One would hope they were Democratic in the first place. The House is what they call the House of Representatives is already under Democratic control, but to move the Senate from Republican to Democratic control would be quite a substantial shift. And that could have an impact on stock markets, because one of the things that Mr. Biden is talking about is a reversal of some of the tax cuts in corporate tax rates in the United States, however, not back to previous levels. He's also talking about higher antitrust provisions and greater healthcare costs that companies would have to bear. And all of those could be negative for corporate profitability. However, I was talking to one of our fund managers based in the US yesterday, and he says despite all of the possible headwinds that a Democratic presidency could entail, he still sees the US market as being attractive on a global basis going forward. However, as the graph on the left-hand side shows here, unless the data, particularly on COVID in Republican states, starts to get better, and it's clearly pretty dreadful at the current time, then the probability of having a Republican president post-November is receding into the distance. So before we move on to take questions in the last sort of 5 or 10 minutes, I wanted to talk a tiny bit about our investment approach. And for those clients that I've presented to in the past, I'm sure you'd be familiar with this map of our funds and some of the strategies that we use and the way in which we conduct ourselves are on the right-hand side. But just as a reminder, the process that we've always taken at St James's Place over the 27, 28 years of its existence is that we shouldn't be managing money ourselves. We should be outsourcing the money that our clients are kind enough to give us to manage to the very best fund managers that we can find around the world. And that's why we like this illustration so much, because it demonstrates the broad global nature of the fund managers that we're working with, whether it is a manager based on the west coast of the United States, a number that are based in the UK, in the Far East, and even a very substantial relationship we have with a manager based in Sydney, Australia. The global nature, we believe, brings our clients the opportunity to work with the best possible managers around the world in the specialisms that we ask them to run money in. And of course, part of the process of the investment management approach is to make sure that we're undertaking due diligence and observations and monitoring on those managers on a very regular basis. And one of the questions that I think came up when we were thinking about running the seminar was, well, what's been happening with the investment committee during the period of COVID-19? And it's suffice to say we clearly haven't been meeting face to face. We've been doing Zoom calls on a more regular basis, and actually we've been finding that the interaction we've been having with members of our investment team, together as an investment committee, with investment consultants that we work with, and with our fund managers, has been pretty much uninterrupted. And whilst it's a slightly different interaction, seeing 2 or 3 fund managers who are in separate rooms, so the sort of behavioural aspects of the way in which one interacts with them are slightly different. Actually, we feel that we get really good quality information and interaction with them. And that doesn't mean that we won't be moving back to face-to-face meetings as we move into 2021, but we've definitely benefited from having video meetings with our managers through this year. We've also been increasing our operational scrutiny of our fund managers to check on things like the liquidity of their portfolios, to make sure that if there are straitened market circumstances, our fund managers are able to operate in the way that we need to. We look at the solvency of those fund managers to make sure that there's no environment where we should be worried about their future capability to run themselves, particularly for small fund managers. And we've been doing a lot of digging around to make sure that the way in which they're running in a remote environment is not going to create any capacity for enhanced capacity for data breaches and that sort of thing. So a lot of sort of background operational work. But we've also been making some evolutions to our fund range. And if you look at, I suppose it's sort of 7 o'clock on this infographic, you can see 2 names there: Sanders Capital and Pazina Investment Management. They're 2 new fund managers that we're bringing into a slightly redesigned global equity income strategy, because we think those 2 managers, both of them based on the East Coast of the United States, are really good at what they do, and we think this is an excellent opportunity for our clients to be working with these 2 great fund managers going forward. So very much a process of evolution continues, whether we're operating in a lockdown virtual environment or whether we're meeting face to face. The other question, of course, is what does that mean in terms of what our fund managers have been doing as we've gone through this process? And again, I think that's really interesting, because what we've wanted to see is our fund managers actually trying to act in a way that is entirely consistent with the philosophy and process that they've espoused for a long period of time. And this was sort of brought home to me in a conversation with one of our managers based in Toronto in Canada, who said that whilst he couldn't remember going through a period as active in terms of what they were doing in the portfolio, in the new ideas that they brought in, because there's been these substantial moves in share prices, in 9 out of 10 of those companies that they brought into the portfolio in 2020, they're businesses that they've known for more than 10 years. So they've been doing research on these companies for 10 years, thinking they're great companies, but been unable to buy them because they didn't like the share price and the valuation they were having to pay to enter into those companies. But because of the substantial setback in share prices, which is in lots of ways indiscriminate at some points, they were able to take new positions in these companies they've been wanting to own for a long period of time. And that was creating exactly what I would describe as the sort of positive rotation in our portfolios that we look for. So what we're trying to ensure is that there's no evidence of sort of rabbit in the headlights mentality of, gosh, markets are difficult, I don't know what to do, I'm just going to sit on my hands and do nothing, or indeed a sort of knee-jerk overreaction to what's going on in the market, feeling as though one has to trade because markets are moving. So it's this objective, rational, behaviourally consistent approach that we think is really the best way for our fund managers to be running money. And it's certainly true that when markets are very challenged, it's very hard not to become short term, because we know from behavioral science. And if you look on my left-hand side here, amongst the books on fund management and markets, there's quite a lot of books on behavioral science. It's something that I'm particularly interested in. And what they describe is the fact that individuals are twice as worried about losing money as they are as making money. And therefore, to make behaviorally beneficial decisions when there is a fear of loss is much, much more difficult. And that's where experience and philosophy and process really comes into play. So I suppose before we move on to questions, the final thing I wanted to do is, what does this mean for clients? Because obviously when markets are moving around a lot, it can be quite disturbing, it can be quite frightening. I remember asking a fund manager of more than 40 years experience back in 2011, 2012, when there was all the worries about the euro breaking up. I said to him, does this get any easier for you with all your experience of major market corrections? And he said to me, no, I stick to my process, but at the pit of my stomach, there is still this gnawing concern about the dislocation that markets are going through. And that's where I think Peter and James and the Morpeth team can really come into play, because they can keep you focused on the longer term goals that you're seeking, keep you focused on what you're trying to do, keep you focused on your assessment of risk and how you think about risk in the way in which you're trying to realize your long-term objective. Making sure, as this slide says, these are our 5 golden rules that have been in place since Sir Mark Weinberg put them together back in 1992. You've got enough cash to meet short-term needs, focusing on the long term, being invested in diversified portfolios, and selecting the very best fund managers where you can around the world from the opportunities that we have. And going back to my mention of the manager that we have based in Sydney, Australia, Hamish Douglas, who works at Magellan Asset Management, what he said was that, and this was actually right at the end of March or possibly the beginning of April, but it was really, really important for clients to stay the course, were the words that he used, because the world isn't going to end, and it certainly hasn't ended, and that the global economy and stock markets will get through this period of challenge. And as I showed, going back to my very first chart on the second quarter performance, he was absolutely spot on, not just in suggesting that markets would recover from their lows, but his portfolio was taking advantage of some of those opportunities in the US technology stocks, which have done so well over that period of time. So James, I'm going to hand back to you if I can now, and I'm really happy to take the questions that I know have been already submitted to you from your clients.
Brilliant. Thanks so much, Chris. I mean, a few things to take from that. Obviously, there's some very positive signs coming through from China, but also, we need to be mindful of the unemployment pressures that I think we're going to feel, particularly in the UK. For me, the US election is always fascinating, and I think this year is certainly going to live up to expectations with regard to that. But I think underlying all of that, whilst that creates volatility, we would echo your comments that it's absolutely vital that we reflect and look at the long term, and we focus very much on the planning that's in place, and essentially everything else that's going on is just the journey that we all need to go on. So thank you very much. Really do appreciate you spending some time with us this morning to go through that. As you said, we have got some questions which have been sent in from clients. So if I may, Chris, can I just ask from one of our clients? They've said, what has the COVID-19 crisis shown us about the assumption on how the St James's Place portfolios would perform in times of stress? And following on from that, do you envisage that St James's Place have learned any lessons from that?
Well, actually, let me start with the second part of that question, because I think it would be arrogant in the extreme to say we haven't learned any lessons. We always learn lessons. We learn lessons about, whether it's operating in a virtual environment through Zoom. We learn lessons about improving the operational oversight of our fund managers. We learn lessons about how fund managers and share prices move in more turbulent times. So the day that any fund manager ever says to you they know it all should be not a day to be working with that fund manager or indeed wealth manager, because one's always learning every day, and that's what I love about markets. That's what keeps me fascinated and I enjoy so much. Having said that, from the perspective of our portfolios, James, I think we are comfortable that our portfolios have performed as we would have expected through this period of time. So when we look at the portfolio performance as an investment committee, what we're trying to see is a map of portfolio performance where the more low risk, sorry, that's a contradiction in terms, the lower risk portfolios, the portfolios where we're trying to retain or trying to realise capital preservation, should be falling less when stock markets are very volatile than the high risk portfolios like the adventurous portfolio, which is 100% in equities. And we definitely saw that that sort of development graph of portfolio performance, that our low risk portfolios were not falling very far and have since bounced back. There were some relatively sharp falls in our equity, in our high risk portfolios, but again, as I illustrated on my first chart, they have bounced back as well. So actually performance has been in line with expectations, and generally because of the type of investments that our managers tend to own, whether it's in equity markets or in fixed income markets, they tend to be of a higher quality. So we don't tend to own companies that have got a huge amount of debt on their balance sheets, and those are the companies that have probably performed more resiliently than the broader market over this period of time.
Great. I think it's probably very reassuring for clients to know that you know, based on their risk profiles and based on their volatility expectations, that the portfolios have delivered that. So I'm sure that's very comforting for clients. If I may move on now to a question we get asked a lot at the moment, and it's to do with environmental, social and governance and the investment strategies for that. So can I ask, how is ESG themed investing impacting on our fund managers, and what proactive steps are St James's Place taking?
Well, I'm really glad this question has come up, because before I started this event, I was having obviously a virtual meeting with a new member. Sorry, my printer seems to be doing something very odd. A new member of our environmental, social and governance team, who's joined in the past couple of weeks. This is an area that St James's Place has been focused on for a number of years now. I would have to say, and I'm not trying to be big-headed about it, but it was an initiative that I really drove, because it seemed to me that this was an opportunity for us to demonstrate the ability that we had in terms of the relationships we have with our fund managers to take advantage of that leverage. And that has been developing very quickly. And if we wind the clock back to the beginning of 2019, what we put into place then was what we described as a minimum set of standards that our fund managers needed to meet or exceed for them to continue on our investment platform. And one of the expectations of that was that those standards were going to be raised every year. So as we push that forward into 2020, a couple of key points. At the beginning of 2020, as an investment committee, we were talking to a potential fund manager who, not surprisingly, was keen to become part of our offering to clients, because we have big relationships with our fund managers. But one of the principal reasons that we decided not to pursue that opportunity with that fund manager was because they weren't prepared to meet our minimum standards. And not only that, they didn't want to make a commitment that they would ever meet them. So we said, well, if that's the case, then we just simply cannot select you as a fund manager. And I think that's it's the first time we've taken that step, and I think it's a really important step forward. And the other thing is that during the year, we've been working with our fund managers to encourage them to sign up to the United Nations Principles for Responsible Investment. And as we sit here today, all of our fund managers are signed up to that, and the two that I mentioned that we will be working with going forward, so Pazina and Sanford, they are both signatories to the UNPRI. So it's not, and I was saying this to this lady I was speaking to earlier, this is not a sort of an activity that's hidden away in the corner of one of our offices. It's right at the heart and centre of our investment proposition, and is actually affecting the decisions that that our fund managers are making on a day-to-day basis, and are being made by the investment committee. And I think this will really increase in importance as we go forward. Yes, COVID-19 has been a distraction, but to some extent I think it's reinforced the messages that we've made about the importance of being prepared for global change. And there was going to be no bigger global change than the threats posed by, for example, the climate emergency. So I think this is going to become more important. It will become more important for St James's Place, and will ensure that the ability for us to describe to our clients what we're doing in this area will become more complete.
Yeah, I think it's, again, reassuring for clients, certainly the clients that we speak to, that St James's Place are driving that conversation with our fund managers, and they're driving the message and putting in place those processes and boundaries for the fund managers to adhere to. So I think that, again, is fascinating and reassuring for clients. If I can move on now, Chris, to obviously the amount of government borrowing that is going to take place to enable the economy to continue to function. We've got a question which essentially is, what will the long-term impact of the stimulus package have on markets?
Well, I think that's the it's a lot more than the $64,000 question, because it's a multi-trillion-dollar question these days. I think it's quite hard to definitively conclude what the impact on markets will be over the medium to longer term. What we know is that not only are the programs for quantitative easing, i.e. the buying of government bonds by central banks, continuing, and central bank balance sheets are expanding incredibly rapidly, but also, as the question asked, government debts are increasing quite substantially. And we've got to a point where, in terms of debt to GDP in the UK, we've got over 100%, the level of 100%, which we haven't seen since the early 60s. So, you know, really substantial levels of debt that the government is currently bearing. And that spending is likely to continue, particularly if we don't see the economic recovery in the UK and other places that's expected. And there's talk in the United States of a further stimulus package that may occur. If we sit here today with interest rates where they are, and one has to remember that in the past 3 months, something that I think we'll look back on is the fact that in the UK, for the very first time, a government bond was issued at a negative yield. And what does that mean in practice? So that means that if you buy that government bond at issue and hold it to redemption 3 years later, you're going to get less money back than you invested, which is sort of a bit odd. That's not the way in which one normally invests. So, and that's guaranteed. It's not just a possible event. It's guaranteed that you will lose money owning that government bond. And that's partly because the Bank of England is buying those bonds through the quantitative easing programme, but they're also being seen as secure. And I think it's not that unlikely that over the next 3 months, we may have a period where the benchmark, the default government bond in the UK, the 10-year bond, actually goes into negative territory. And that means that financing costs in the short term are actually relatively low for governments around the world, whether it's the US, the UK or in Europe, and that reduces the pain of the high debt to GDP levels. Having said that, if one of the potential outcomes of this government borrowing and the monetary easing is inflation, then it is likely that cost of debt servicing will increase. Now, whilst I think it's extremely unlikely that substantial inflation will come into economies in the next couple of years, it is not at all inconceivable that if one looks on a 5 to 10 year view, that inflation may become more of a problem. Having said that, we did say that post the global financial crisis when quantitative easing was first introduced. So what will be the long-term impact on markets? To come back to the question, I do think it is very difficult to tell, but if the quantitative easing programs, the extra, the proportion of government as part of the global economy continues to increase, that is likely to be an inhibitor to longer term equity market returns. So I think trying to expect equity markets to returns to be say in the mid-teens or higher on a compounding basis over the next 10 years, I think they're really going to struggle to make that. But if you compare that to what you're getting on money on deposit, which is nothing, or in real terms after adjusting for inflation, negative, then a positive return anywhere near double digits for equity markets would be seen as being quite good.
Thank you. I think that's one of the questions that we often get asked is our lower risk portfolios, how do they perform relative to cash? And from what you've said there, obviously with negative returns on cash, any positive returns that we can try and get for clients certainly is advantageous. Obviously, we've talked a lot about bonds and a lot about equities over the past 30 minutes, but one of the questions that we do get asked is about the St James's Place Commercial Property Fund, which clearly is a very, very different asset class. And obviously with commercial property going through some challenges, can we just ask a question about our commercial property fund, and in particular, is there any sign of that reopening?
Well, I think it's probably worth winding the clock back to making sure that everyone is familiar as to why we suspended the fund in the first place. The reason that we suspended the fund was because the independent valuers for that fund, not us at St James's Place or the managers, Orchard Street Investment Managers, but the independent valuers of the properties that we've got in the property fund, came to us and said that according to the regulations that are set by the regulatory body in the property sector, they were unable to perform the valuation tasks that were required to put out a value on the properties in our property portfolio. So we had no choice but to suspend the fund, because if we couldn't value the properties in it on a defined basis, then any price that we put on the fund could potentially be misleading. So that was the reason we suspended the fund. So it wasn't to do with falling values, it wasn't to do with people selling the fund and cash flows becoming substantially negative, the so-called run of the fund. We didn't experience any of that. And what we wanted to get to was a position where CBRE, the valuers, were saying to us, we now feel that we can value the properties in the fund. And I think it's fair to say we are closer to that, but we're not quite there yet. And whilst I think there is an expectation that we will be reopening the property fund this side of the end of the year, I feel it would be probably inappropriate for me to try and focus on a particular date for that. But I feel confident that we're definitely moving in the right direction. I do think it's worth, though, focusing on the properties within our property portfolio, because one of the things that has been written about in the media is the impact on property funds that have got a lot of exposure to either the retail high street or big shopping centres or very big office blocks. So within our portfolio, we've got a much bigger focus on small offices, and they're much easier to transact, and they tend to be in more demand because the space is relatively flexible. And particularly, we've got to focus on out-of-town retail warehouses. So the sort of thing that the Ocados and Amazon of the world are using and are in fact in high demand. And the valuations on those properties have, if anything, increased as we've gone through the past 6 months rather than decreased. And our exposure to shopping centres and high street retail is really substantially smaller than that, and therefore we haven't seen some of the impact that other property managers have experienced in those sectors. So I think it's a sort of a positive story all round. You know, the quality of our property fund, the work that Orchard Street have done as managers has been really good, and we're in an environment where we will be able to reopen that fund to clients in, you know, the not too distant future.
Great. That's really encouraging news. As I said, we've got lots of clients who invest in different asset classes, and certainly commercial property is one of them. So I appreciate that. So thanks for all of your answers there, Chris, to the questions. So to everyone, thank you so much for joining us this morning. We hope you found it of use and very informative. Thank you also to Chris for joining us as well this morning, Chris. So thank you so much for being part of our webinar this morning. Really grateful for you to spend some time with us today. So it only leaves me to say we wish you all well. We hope we get back to some sort of normality as soon as possible. As I said, we are back into the office now. We are sort of greeting clients as and when is required. So again, we look forward to seeing you all very soon. If you've got any feedback about today's event, please email us at info@themorpethpractice.co.uk, and we look forward to seeing you all very soon. Take care. Bye bye.